Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and generate consistent returns year on year. So the first thing you want to do is pull up your brokerage platform. We're using Tasty Trade, and of course we are going to be writing options contracts, so we need to know where we are in the options cycle. So you pull up any underlying, for example, we've got Apple here, and we are presented with a list of expirations in the trade tab. Everything with a orange W is a weekly, everything else is a monthly expiration. We're going to stick with a monthly expiration, and we want to be between 30 and 60 days out in time. Ideally, 45 days would be perfect. So October 18th is the next available expiration. Monthly expiration is 18 days away, far too close. So we're going to go to the next one out, which is November 15th, 46 days away, which is much more suitable. So now we know 46 days is going to be the starting duration on our contract. We can then pull up our watch list. It can be any watch list. It just needs to be a list of things that you can trade. And then you want to filter out everything that has earnings over the next 46 days. And we also want to filter out everything that has a low liquidity level. So what we're left with is very liquid underlyings that do not have earnings. And all that's left to do at this point is filter everything or sort everything from high IVR to low IVR. The reason for this is we sell when volatility is high, and we play the contraction back down to the mean and even further. So what we want to do is we want to ideally pick something that has a IV rank of over 50. Anything over 50 is considered high. With that in mind, we want to pay attention to what is already in our portfolio. We want to make sure that we're not opening positions in sectors that we're already heavy in. We want to make sure everything is nice and diverse. So we want to just go down the list. We've got a bar with an IV rank of 126. Let's just take a look at that. As we can see here, we've had a massive jump in IV rank, and today we gapped up over the weekend and markets just come straight down, hence the even higher IV rank today as opposed to on Friday. So if you go back onto the watch list, we've got Neo. Neo could be a nice one. It is a very small product though. It's only trading at about $7. Baba we did go over the other day. FXI, Baidu we had a look at the other day. EEM we've got USO, GDX, XOP. Let's have a look at XOP. It's trading at about $131 at the moment. It's got an IV rank of 51.3. And it looks pretty decent, to be fair. So let's have a look at XOP. We already know we're going to be November 15th. This is now the options chain that we're looking at for the November 15th expiration. The horizontal orange bar shows you where price currently is. The vertical orange bar shows you the expected move of XOP over the next 46 days with respect to the rest of the strikes. So there's two types of contracts, calls and puts. We're going to sell one call and one put. Where are we going to sell the call and the put? Well, I like to go anywhere between a 15 and 20 delta on either side. So if you look at the delta column, go all the way down to a 15 or 20 delta. We've got an 18 delta here at the 146 strike, which looks pretty nice. So if you go over to the put side and we want to do the same, there's an 18 delta on the put side at the 119 strike here. And that's it. This is the position. This is called a strangle. A strangle is a naked position. As you can see here, our contracts are further out. They are further beyond the expected move. And what that's going to do is going to ensure a very high probability of profit. And that can be seen here. We've got a 71% chance of a successful trade here. And we have an 85% chance of hitting 50% of max profit over the next 46 days. So this is a very high probability trade. And if you were just to plot this on the graph, let's see what that would look like. So we've got our strikes at 119 and 146. So you've got our strikes at 119 and what was it, 146, which is about there. It's not perfect, but that will do. So this is roughly the range that we would be creating for ourselves, and we would want price to stay within this range. And there is a 71% chance of price being within this range at expiration. So that's what the position would look like. Let's have a look at the numbers. So we'd collect $278 upfront in premium, and our broker would require just under 1.4K in buying power. So this is a very nice return on capital trade, especially for a naked position. XOP is an ETF with a very nice IV rank. ETFs generally do lead to a smoother P&L in your portfolio as opposed to individual companies, because of course you don't need to deal with individual company risk at the ETF level. So this is what a position would look like in XOP. If, for example, 1.4K was a bit too dear for you, by all means, what you could do is you could simply just buy a contract a little bit further out. So on this side, we've got the 146 and the 150. So if we were just to buy the next contract, a contract, the next strike down, which is $4 wide, and we were to do the same thing, $4 down at the 115, what we've done now is we've created a spread on either side that is $4 wide. And what that's done is just massively reduced our buying power, because if you notice now, our max loss is now limited. The long contracts limit our loss potential. Before, on a naked position, it was unlimited loss potential, hence why the buying power was so much higher. So we've limited our loss. We do collect less premium, but we do require less buying power, and this overall works out to be a much higher return on capital trade than the naked position. However, you will have a slightly lower probability of profit, and that is the trade-off. You also will get a slightly lower daily theta decay as well. So that's also something to keep in mind. So it doesn't matter what size portfolio you have, you can put this position on with just $300. So that's XOP. There is something else you also need to keep in mind when it comes to finding positions, and that is the size of your positions. So we've got a position sizing template for everyone to use. It's completely free to use. The way it works is you enter in the size of your portfolio. Let's say if it's $10,000. Below that, you then enter in what the current VIX level is. Let's say if it's 25.3. Everything will then be automatically calculated for you. All you need to do is use this information to form the backbone of your portfolio. It will tell you how much buying power to allocate to undefined risk positions, defined risk positions, and how much of your portfolio you should allocate to short premium strategies in general. So as long as you follow this, you will be fine. To get a copy of this, click the link in the description, head on over to free position sizing template, and that will take you to the spreadsheet. If you would like to copy our positions and see what we're doing in our portfolios and make money alongside with us, again, click the link in the description, head on over to EDS Premium, get yourself signed up. Inside, you will have access to all of our portfolios, so there's always a position for you to copy. Doesn't matter what size portfolio you have, there is a full course. No prior knowledge is required. We'll teach you everything you need to know. This is going to allow you to learn and earn at the same time. It is a private community, so you can speak with myself and other like-minded individuals. There's also a 100% money-back guarantee. So if you studied our full course and followed all of our trades for 6 months and you haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free. It's £1 a month right now. The price will be going up, but once you're in, you don't need to worry. As long as you don't quit and rejoin at a later date, any future price increases will not affect you. So you are rewarded for getting in early. And with that being said, I'll see you guys on the inside.